The stock market is up over 40% this year. Stocks can't go up in a straight line, unfortunately. And there are really a bunch of major signals out there that are signaling we could see a large pullback in the stock market and a recession in the foreseeable future. In this video, I'll go through the top 10 reasons why I think we are in for a huge stock market pullback. So, with that being said, let's start it off with this undefeated recessionary signal. So we first off, this is a yield curve inversion. So yield curve inversion is basically when the 2-year yield is above the yield of a 10-year treasury, and this has happened only 12 times since 1978, and each instance it has led to a recession. So this is an undefeated recessionary signal, and the average time from start of inversion to recession has been 18 months on average. And this is crucial because the yield curve inverted in July of 2022. Therefore, we are coming up on that 18 average time frame. So, if this signal is correct, which it has been, it's 12 for 12 since the late 70s. We could be seeing a recession in the coming months. We see employment data kind of weak. We're seeing some recessionary signals throughout the economy. So it seems very conceivable that we could see a recession in the foreseeable future, which would obviously push stock markets lower as earnings come in weaker than expected. So with that being said, though, let's take a look at our next signal here. So our next signal is the effects of interest rates haven't been felt yet. So that's kind of our next reason. And this is typical. So when the Fed raises interest rates, it doesn't hurt the economy right away. It takes some time for economic activity to slow in reaction to that interest rate hike. So changes in monetary policy don't happen right away. There is some lag in that. And typically there's anywhere from a 12 to 18 month lag. And when you consider that the Fed started hiking rates in March of 2022, we're kind of just coming up to that average range. So we're just starting now to feel the effects of the interest rates that have been taking place by the Fed. So we haven't been feeling this yet, and we're just starting to see very weak employment data, and I really think that that's going to continue, and we can see that this broadening out of weakness through the economy in reaction to higher interest rates. And like I said, we are just starting to feel the effect of higher interest rates. And then that's kind of a good transition into our weak employment numbers. We actually just got some weak employment numbers today. Believe it or not, we had job openings slide to 8.7 million in October, which is well below the estimates and the lowest level since March of 2021. So, basically 3-year lows here for job openings, which signals employment is starting to weaken, right? And that is really just a reaction to the broader economy, right? So if people aren't hiring, that's signals something about earnings, right? Something about what those companies are making. So this really signals economic weakness, and I think we're just starting to see employment data represent the Fed's hawkish stance. As I said, that monetary policy change acts on lags. And then a very clear chart here is permanent job losses have also accelerated. So we've seen permanent job losses accelerate over the past 18 months or so. And this is actually somewhat of a recessionary signal. So we had permanent job losses obviously increase during COVID. We saw that slight and quick recession. And then in 2008, we saw the same thing before we jumped into recession. And then in 2000, the dot-com bubble, we saw a similar chart where we saw permanent job losses increasing. And right now, over the past 18 months, we've just started to see those permanent job losses accelerate, which, if you look at history, should imply a recession. And then let's take a look, or let's just talk through, I should say, these global tensions. So, yes, we see what's going on in Israel, right? Everyone knows that Israel, Hamas, Palestine, there's a lot of conflicts going on in the world. Obviously, we still have Ukraine, that war isn't being talked about, but it's still rolling along. It's really as deadly as ever. So, two major conflicts across the world, and we're also seeing the US unfortunately get more and more involved. Obviously, the United States has been involved monetarily, right? We've been funding Ukraine, we've been funding, you know, Israel, and also Hamas, people that have been affected by the bombings in Palestine. So, a lot of money, a lot of U.S. money is going to these wars, but we're now just starting to see U.S. Assets, U.S. military assets be deployed. So we've seen U.S. Ships be actually attacked by Iranian proxy forces, as the New York Times calls it. They've been called militia, right? They to kind of distance Iran from this attack. It's been Iranian backed militia, not actually Iran. Essentially, though, it is pretty much Iran. So this could force, if the U.S. and Iran start to butt heads on the battlefield, this could force a broader conflict for the United States, right? So this could be a huge issue and really could exacerbate this war. Obviously, we have tensions still with China. We have tensions, obviously, still with Russia. So there are a ton of different fronts that U.S. is seeing some conflicts on, and those could spiral and snowball into larger conflicts, which would obviously be a major negative for the stock market. And then let's take a look at some of the studies that I've seen done on economic changes and changes in the stock market when you see a change in president. So in 2016, we saw a positive reaction to Donald Trump being inaugurated. We saw the Dow move up 10% that year. This is a study by Investopedia on the effects of that. So we saw, the Dow move up 10% that year. And then in 2008, when Obama was elected in, we saw, the markets fall 26%. Or I shouldn't say elected in, but he was, kept in. Or excuse me, no, that was his first term, if my memory is correct. Sorry if I'm wrong about that. And then we saw the Dow climb 5% after Bill Clinton was elected. These elections tend to have major impacts, but really why it's a negative is because there's so much uncertainty, one, on who's going to be elected, and there's great variance between the Republican Party and the Democratic Party. So the Republican Party wants to tamper down spending, wants to spend less, right? And if you take dollars out of the U.S. economy, that essentially could hurt the stock market. Obviously, there's a ton of factors there. So generally, in terms of fiscal policy, in terms of pumping money into the economy, there's great variance in the parties right now. So that creates some instability, that creates some uncertainty in modeling economic predictions, modeling stock market performance, because you don't know the dollars that will be in the economy. So all this really creates is uncertainty, and uncertainty is a negative for the stock market. So uncertainty could be plaguing the markets. And if we see a drastic fiscal policy change, or even a new war started by one of these parties, we could see a negative market reaction, right? And maybe we see a hike in taxes in reaction to more fiscal spending. Maybe we see a drop in taxes. There's just so much variance. That's my point here. I'm not saying that one party's good, one party's bad. That's not what I do on this channel. But there is a ton of variance in between the effects that these parties can have on the stock market. So I'll leave that there. The political situation is very uncertain right now, and the markets hate uncertainty. And then one thing here is that the Fed is removing liquidity from the system. So this is the reverse repo market, basically the overnight lending market for banks here. Kind of complicated, but all you really need to know is that as this chart moves up, basically the Fed is pumping money into the economy. It's helping the banks lend money. So we've seen this increase since 2021. We've seen a pretty drastic increase in the Fed's involvement in the reverse repo market. So they're basically, like I said, pumping money into the economy via banks, and then banks are kind of going out and stimulating the economy as well. The issue is this liquidity is kind of running out. So if you take a look at history here, we can see that this isn't very typical. We don't see this happen, a lot here. It's really in periods of economic instability we see this happen. So the Fed naturally wants to kind of taper this off, right? They don't want to be artificially propping up banks, so they can kind of lend out more aggressively. So all you need to know is that as these numbers go down, liquidity in the system, dollars available to folks to put money into stocks are going down. So the Fed is pulling liquidity from the system, and they're also selling mortgage-backed securities. So I know if you hear mortgage-backed security, it's kind of a dirty word, right? Everyone just thinks 2008 major disaster. But recently, so the Fed had been, like before 2020, the Fed had been selling down their mortgage-backed securities as the economy was strong, and they had the ability to. But since 2020, they've been buying them aggressively. And all this does is it just kind of props up the housing market. So as the Fed, though, continues to sell down their mortgage-backed securities, it actually hurts banks. So it's just another way that the Fed is kind of removing liquidity from the system. So it really affects banks, and I'll explain how that happens. So just to give you a gauge, though, in 2020 we were at 2.7 trillion dollars in mortgage-backed securities. Right now we're at 2.4. So massive drop there. And then if we take a look at this example that I've laid out, how does this affect banks? Well, it actually makes it harder for banks to lend because a lot of their assets are collateralized with mortgage-backed securities. So I'll give an example here. So the Fed selling down $200 billion worth of mortgage-backed securities, it brings down the value of all mortgage-backed securities. And banks that own these mortgage-backed securities see the value of their assets drop, right? And that makes it harder for banks to pay depositors as the investments they have made with customer dollars, with customer deposits, have lost value. And I'll give a stock market example for people that this isn't really making sense to. So BlackRock, let's say BlackRock sells $200 billion worth of stock. That's going to bring down the stock market, right? Simple supply and demand, that's going to bring down the stock market. Let's say you own stocks, you're going to see the value of your assets drop, which in turn makes it harder for you to pay your mortgages as the value of your assets drop. So that is kind of essentially using you as the bank example, if you will, and the depositors as mortgage back, or I should say mortgage originators. So simple supply and demand. If the Fed sells mortgage-backed securities, it's like selling stocks, and they're basically bringing down the market for mortgage-backed securities. So if they bring down the market for mortgage-backed securities, the value of the assets that a bank holds is going to go down. And why does that matter? Why does the value of the assets on a bank's balance sheet matter? Well, I'll show you with this example. So let's say we have Happy Investing Bank. We were established 2020. We have two depositors, Joe and Jane. They give us $50 each. And just to kind of look at our balance sheet here, we have $100 in value on our balance sheet in assets in 2020. And let's say by 2023, we only have $40 in value, and we have losses of $60. So let's say we make a bunch of investments into mortgage-backed securities, they go down a ton. We make a bunch of investments into to longer dates treasuries, they go down a ton. That kind of happened with SVB. Um, so we lose a bunch of customer money essentially. So why does that matter? Well, in this example, in 2023, we lost $60. So we only have $40 in assets. So if Joe and Jane here come back and they say, hey, I want $30 of my money back right now. If Joe goes and he says, I also want $30 of my money back right now, well, we only have $40 in assets. So we can't pay them. That's basically how a bank run happens. Super high level, super simply. So that's why the assets that banks hold really matter to the economy, and they matter to everyday people. So wanted to make that example, but let's keep it moving here. So also, the real estate market is stalling, which could cause home prices to drop. So the wealth effect could cause stocks to pull back, as when people feel less wealthy, right? When their house goes down in value, they tend to spend less on stocks because they don't have much in assets, right? So as home prices drop, stock prices tend to follow, just because one, they're economically correlated, and two, like I said, that wealth effect is very real. And we can see mortgage demand has hit April 1995 levels. So there isn't much demand for mortgages. Obviously, interest rates have gone up a ton, and that's a large part of that. And then the housing affordability index has gone down a ton as well. So we're actually it hasn't been less affordable to own a home since 1989. So if you're renting right now, if you're trying to find a home and it's hard, you're not alone. You're not crazy. You're not imagining it. It is the unfortunate reality that we are all living in right now. But what I read this as is, okay, the affordability to own a home is going down. Therefore, we could see, some stalling there, right, in the housing market. And this also tells me that affordability has to turn around eventually, right? And how does affordability turn around? Housing prices drop. And that would be a negative effect on the stock market, as that wealth effect comes in there. And we can see people also just don't feel like buying a home right now. So this shows you the amount of people that are thinking um, it's not a good time to buy a home right now. And we can see these levels are at 1980 levels in terms of pessimism on the housing market. So once again, a reason why housing prices could fall. And then a really concerning reason, our eighth reason here, is that credit card debt is at all-time highs. I'll show that chart first. Credit card debt is at all-time highs. So consumers have never been more in debt. And we also have savings contracting. So we're unfortunately at, pretty low levels of savings. Savings have been dipped into, and pretty much anytime we see a contraction in savings, or I shouldn't say anytime, but typically when we see a contraction in savings, it does imply a recession. So it worked in 2019, or in 2020, I should say. We had that COVID recession. And then in 2008, we saw a savings contraction as well. So this signals to me, again, a major recessionary signal, and a reason why stocks could really fall. And the worst part about this is we're seeing savings contract as debt hits all-time highs. So it doesn't take a PhD to understand that that is a bad economic situation. And then, so we recently had a downgrade of the U.S. economy, and this could lead to further downgrades of U.S. debt, which could cause higher financing costs for the U.S. economy. So Moody's recently had downgraded the U.S. economy to a negative outlook. And this comes as we're actually rated not as a prime lender here. So we're actually, or we don't have a prime credit rating, I should say. So the S&P 500 has us as a AA plus, which is a high medium grade. Moody still has us as prime. Fitch has the United States as double A plus, and we see DBRS has the US as AAA. So unfortunately, the four major credit rating companies here are basically split. They don't have the US as prime. So let's say Moody's comes in. I mean, they just downgraded the US to a negative outlook over the past couple of weeks. It wouldn't be inconceivable if we saw some poor economic data that we could move down to a high medium grade for US debt. And I know this doesn't sound like much, but it will increase the cost of financing new debt for the United States. So this will cause interest rates to rise, and this will make it harder for the U.S. to pay its bills, basically. So this is another reason why we could see the stock market fall, because interest rates would rise if Moody's continues on this trend and saying that the U.S. is unstable. So be on the lookout for that. And then also our final reason here, this is a bit more speculative, I will admit. So we're seeing COVID, flu, RSV on the rise in California. So we've seen COVID cases jump up. And then we're also seeing this new pandemic, or excuse me, I shouldn't say the word pandemic, but this new virus coming out of China. I shouldn't say new either. I don't know what the heck this is. I'll admit that. So this is a China pneumonia virus. We've seen a bunch of different warnings from different countries that they're seeing hospitalizations for this virus increase. Some people are worrying that this could be kind of the next pandemic. So China's hospitals have been flooded with cases of respiratory illness and sick children complaining of pneumonia-like symptoms, leading to increased scrutiny from the World Health Organization. The World Health Organization has reached out to China and basically said, hey, we need more information on this. And the respiratory illness is caused by known pathogens, according to the WHO. They said similar things at the start of COVID-19, but that's good. It's at least good to hear that the WHO isn't as worried as honestly I am. And one thing that really worries me about this new disease is we're seeing countries like Denmark declare at an epidemic status as this pneumonia cases continue to surge. So I'll read you a quote from a Denmark official here. Denmark official says, in the past 5 weeks, the number of new cases has increased significantly, and we are now seeing significant cases more than usual, and there is a widespread infection throughout the country. So a reemergence of COVID or a new disease. Some people have been looking at the white lung disease. There's been a lot of different viruses popping up, and there are definitely risks to the stock market. We saw what happened with COVID. We saw what happened to the stock market during that time. So don't be shocked if we see another virus come in here and unfortunately cause some major shock waves throughout the stock market and the economy. So of course, the Fed is likely to cut interest rates over the next couple months, but history implies that the Fed typically overdoes monetary policy in both directions. We saw it in COVID, right? They kept rates low too long. Transitory was wrong. And now I fear that they are going to keep rates too high for too long. This is very typical. What the Fed does is they stay in their positions for too long. So unfortunately, I think the Fed is going to overdo it. I think we're going to move into a recession, and I think we get a larger stock decline in the foreseeable future. So with that being said, I hope you enjoyed this video. I hate being a pessimist. I really do. But I really felt I needed to give this video out to my subscribers. So I hope you enjoyed it. If you did, please leave a like and subscribe. I post videos like this all the time, and I'll see you here next time on this channel.